Assalamualaikum students, and thank you for joining today's session. In this lecture, we are going to learn one of the most important concepts in accounting, and which is the accounting cycle. This cycle is followed by every business, whether it is small or large, because it helps in recording, summarizing, presenting financial information in a systematic way. Think of the accounting cycle like a story of a business, from the very first day of the period to the last day. We started by recording the small transaction and will end up with the preparing final financial statements. By the end of this lecture, you will clearly understand each steps and you will be able to explain it confidently with examples. The counting cycle generally consists of 8 specific steps, and number one is the generalize the transactions, that is the recording the transactions. Second is the post each journal entry to the appropriate ledger accounts, that is the ledger accounts. And third one is prepare a trial balance. And fourth one is the making end of period adjustment, and these are called as adjusting entries. Number fifth is the preparing an adjusted trial balance after the adjusting entries. And number six is the preparing financial statements. And seventh is the generalize and posting closing entries at the end of the year. And eight is the preparing and after closing trial balance. Number one step, that is the analyzing and recording transactions, means the journal entries. The counting cycle always begins with when a business performs a transaction. A transaction means any financial activity such as buying goods, paying salaries, receiving cash, or providing services. Before writing anything in the journal, we analyze the transactions. We ask ourselves which accounts are affected. Is the accounts increasing or decreasing, or should we debit or credit? For example, imagine a business receive 50,000 cash from the owner or as capital. In this case, cash increases and the capital also increases. Cash is an asset and asset increases with the debit one. And then capital is equity and equity increases with the credit. So the journal entry will be cash debited and owner's capital credited. And the second example or another example is when a business purchases office supplies worth 8,000 rupees on cash. Supplies increases, so we debit supplies, and cash decreases, so we credit cash. The journal entry becomes office supplies debited and the cash credit. Recording journal entries ensures that every transaction is captured in a financial record with accuracy. Second step is the posting journal entries to ledger accounts. After we record the entries in the journal, the next step is to post them into ledger accounts. The ledger is like a big book where each account has its own page. All debits and credits related to the particular account are collected here. This has helped us to know the total balance of each account. For example, when we posted the cash account earlier in 50,000 debit and 8,000 credit with both appear in the ledger, cash ledger. After posting, the cash ledger will show a balance of 42,000. Like 50,000 minus 8,000 is the 42,000 balance of the debit side. The balance is important because later we will use it to prepare the trial balance. Ledger posting simply organize journal entries into specific accounts so that we can see the complete history of each account. Third step is the preparing the unadjusted trial balance. Once all the journal entries are posted in the ledger, we prepare the unadjusted trial balance. A trial balance is a list of all the accounts where their ending debit or credit balances. The main purpose of this statement is to check whether total debits equal total credits. If they match, its mean entries are mathematically correct. If not, we know there's an error somewhere. For example, suppose the ledger account show the following balances like cash debit 42,000 rupees, supplies 8,000 debit, revenues 20,000 credit, salaries to 5,000 debit, and the total owner's capital is the 35,000 rupees. When we prepare trial balance, we list these accounts and this preparing the adjust trial balance help us to see the big picture before making adjustments. If we add capital 30,000 rupees, then the total will balance 55,000 rupees. So this is the third one step. This is the preparing the unadjusted trial balance and it should be equal. Debit side and the credit side. Then step number 4, preparing adjusting entries. There are different types of adjusting entries. At the end of each accounting period, a business needs to make some adjustments so that the financial statements show the real and financial position, fair financial position. These adjustments help us to record expenses and revenues in the correct period, even when cash is not moved yet. Adjustment make sure our financial statements follow the matching principles. These principles say expenses should be recorded in the same period as the revenues they help generate. Although every business is different, most adjusting entries fall into four major types, and each one tells a small story of time. Number one is the converting assets into expenses. Second one is the converting liabilities into revenues. And third one is accruing unpaid expenses. And fourth one is the accruing uncollected or unrecorded revenues. And then number one is the converting assets into expenses. Imagine you buy something today like supplies, insurance, but you will use it slowly over many months. At the time of purchase, we record it as an asset because the benefit will come in the future. For example, you debit supplies or prepaid insurance and debit and credit the cash. But as time passes, part of these assets gets used up and the used portion become an expense. So at the end of the period, we adjust by debiting suppliers expense or insurance expense and crediting the asset. For example, the adjusting entries of converting assets into expenses is the suppliers expenses, the debit, and suppliers is the credit. In simple words, what we used must be shown as expense. This ensures expenses are matched with the period in which the benefit was received. Second is the converting liabilities into revenues. Sometimes businesses receive cash in advance, like customers pay before getting the services. Since the business had not yet earned this money, but it is a liability called the unearned revenue. But as a company provides the services over time, it slowly earns that money. At the end of the period, we must show how much revenue was truly earned. The adjusting entries reduce the liability means the unearned revenue and increased revenue earned. And the adjusting entry for the converting liabilities into revenues is the unearned revenue debit and the service revenue is the credit. Simply, we must convert that part of money we truly earned from a liability into revenue. This helps the income statement tell the real story of how much income we actually made. And third one is the accruing unpaid expenses. Some expenses happen even when we have not paid cash yet. For example, employees have worked but salaries will be paid next month, or interest has accumulated but will be paid later. These are called accrued expenses. If we do not record them, our expenses will look like artificially low. So, an adjusting entry is made by debiting salary expense or the interest expense and crediting salaries payable or interest payable. Like this, salaries expense debit and the salaries payable credit. This ensures that expenses are shown in the period in which they occurred, not when the cash is paid. Fourth one is accruing uncollected or unrecorded revenue. These are times when a business, there are times where a business has already earned revenue, but the customer will pay later. So no cash has been received yet. For example, you provide a service today, but will receive payment next month. This earned but uncollected income must still be shown as revenue. Therefore, we recorded an adjusting entries debit accounts receivable because the customer owes this and credited the relevant revenue account. And this adjustment makes sure that revenue is recorded when earned, not when cash arrives. This keeps our income statement accurate um, and up to the date. This keeps our income statement accurate and the up to date, and the adjusting entry is the accounts receivable debited and service revenue credited. Adjusting entries helps us to correct amount or account balances before preparing the financial statements. Then the fifth step is the preparing the adjusted trial balance. After posting all the adjusting entries into the ledger, we now prepare the adjusted trial balance. This statement is similar to the unadjusted trial balance because, but now the balances are updated after adjustments because it includes all the corrections, and the adjusted trial balance is considered the most accurate summary of the account balances. For example, after adjusting the suppliers account by 6,000, and the suppliers ledger will now show the remaining balance of 2,000. This update amount will appear in the adjusted trial balance, and similarly rent expense will now show 4,000, which will also be included. So the total of the adjusted trial balance match. Then we can move to the next step with the confidence. And the adjusted trial balance is the cash, office supplies, supplies expense, rent expense, revenues, and owner's equity, and these both balances are equal 55,000. Next step is the preparing financial statements. And using the adjusted trial balance, we now prepare the financial statements. There are five uh, financial statements. Three are major, and other are other financial statements. Uh, Number one is the income statement. Second is the statement of owner's equity. Third one is the balance sheet. Fourth one is the cash flow statement. And fifth one is the notes to the accounts. We begin with the income statement. In this statement, we report all the revenues and expenses to calculate the net income. For example, if revenue is 20,000 and total expenses are 11,000, the net income is 9,000. This net income will be used in the statements of owner's equity. Second statement is the statement of owner's equity account. Statement of owner's equity statement explains changes in owner's capital during the period. We begin with opening capital, add net income, and subtract drawings and calculate ending capital. If the owner starts with 35,000 and earn 9,000 net income and withdraw 4,000, the ending capital becomes 40,000. And then we prepare the balance sheet. The statement shows assets, liabilities, and owner's equity at the end of the period. Assets like cash, supplies, prepaid rents are listed along with the liabilities such as accounts payable, notes payable, and owner's equity include the ending capital amount. The balance sheet must follow the accounting equation, that is the asset is equal to liabilities plus owner's equity. Then cash flow statement. The cash flow statement of cash flow, also referred to as the cash flow statement, is one of the three key financial statements, and the cash flow statement reports the cash generated and spent during the specific period of time, like a month, quarter, year. And the statement of cash flow acts as a bridge between the income statement and the balance sheet by showing how cash moved in and out of the business. And finally, notes to the accounts, and yet also known as the notes to financial statements, are an integral part of company's financial report that provides detailed explanation for the figures in the main statements. such as the balance sheet and the income statement. They include information on accounting policies, assumptions, and disclosures like contingent liabilities, debt details, and employee benefit plans. These notes are essential for stakeholders, including investors and the auditors, and to fully understand the financial position and the activities of the company.